Well, I'm the Cardinal.
And I'm the Hill in Cardinal Hill Wealth Management.
Jesse Harris here, CFP.
You know, Jesse, tell us about yourself. Why are you wearing that interesting color of maroon?
Wow, great question, Robert. It is actually the purest form of maroon if you look it up.
You're into maroon, I guess.
I went to school at Texas A&M, and we happened to make the college football playoffs this year.
Oh.
We did lose in the first round, but thankfully, Miami made us look a little bit better.
Nice.
You've got a...
Yeah, got some Baylor Bears here. Got
Very
some
Baylor Bears.
I am Robert Hill, CFP, PhD. Told to say that every time.
Yep.
Yeah, Baylor is a great school. We don't quite have the budget of an A&M to buy players. Must be nice, but we do our best.
Stinks to be you.
Oh, it's kind of good. It's pure football. It's fine. All right, so today we're going to be talking about stock options, yeah?
Yeah.
Awesome.
Stock options. Broadly speaking, if you're getting stock options, that's a good thing. I mean, you're getting to participate in your company's growth as a company, and hopefully they are growing. But regardless, it gives you the option to participate in that growth as well as to buy those stocks at some point. But before, that they're given to you, so there's no risk really, which is really fun. And then you get to decide when you sell these options. It says right here, you should wait till you think it's at a high. We don't think that you can time the market. So I think you should sell when it makes sense for your plan, but you need a plan.
Yep.
But there's just a lot of factors to consider when you are selling your options. Taxes, cash on hand, concentration risk, things like that. So a lot of things to consider that we're going to go into.
So first, in order to understand stock options, you kind of have to understand four main varieties of stock options. And this is that was number 4. You can keep track. These are mostly limited to like publicly traded companies. So this is kind of what we're talking about right now. So first up, there's non-qualified stock options. We call them NQSOs, number 1. So non-qualified has to do with the qualification status of the taxation of the options. And so in general, when you exercise an NQSO or non-qualified stock option, the difference between the exercise price, let's say your company, the exercise price was $10 a share and your company's fair market value is 15. The difference between that is taxed as ordinary income. And so your employer has to withhold federal, state, and FICA taxes on the exercise of NQSOs, whether you hold on to those shares or you sell them immediately. And so it's still great to be, given a chance to participate in the upside, but they're, in our minds, we kind of think of them as maybe the least favorable tax treatment in terms of the 4 types we're going to review today. So that was number 1. Number 2 is incentive stock options or ISOs. It feels like these are becoming less common, at least with our clients, but they have some really neat advantages, a little bit more complex to talk through. So with ISOs, back to that simple example, if your company, the strike price or the exercise price is $10 a share and they're trading at 15, the difference between the 10 and 15, the bargain element is not immediately taxable for regular income tax. At the time of exercise. So you can choose when to exercise, but once you exercise, it is what's called a preference item for alternative minimum tax, which is this sneaky separate tax code that's always running and that can get hit and surprise you if you're not watching for it. So that is a temporary bargain element in the year that you exercise. But in general, there's an opportunity to get long-term capital gains treatment on that bargain element as long as you hold it for enough time after exercise. So that bargain element is taxed at a long-term capital gain if you hold the options 2 years after the grant date and 1 year after exercise. And so if it's 2026 and you get a grant, you have to wait at least until 2028 based on the grant. Also, you have to wait 1 year after exercise. So if you waited till 2028 to exercise, you got to wait till 2029, day after, to get that long-term treatment of that bargain element. If you sell the shares before 2 years after the grant date or before 1 year after exercise, you have what's called a disqualifying disposition. And so that means that at the gain at sale up to the spread at exercise is now taxed at ordinary income, you're kind of unwinding that favorable treatment, with additional cap gains up to the sale price taxed as a short-term capital gain, which is the ordinary income treatment. Wah, wah, wah. It can still make sense at times based on your feeling of the company health, or there's lots of ramifications, but the tax qualification, you lose that if you don't follow all of the dot all your I's and cross all your T's. ISO spread is not subject to FICA taxation, which is great, and your employer is generally not required to withhold taxes when you exercise ISOs. So please work with a wealth manager and a CPA, get some qualified folks to look through these very, very nuanced, and there's other rules we'll talk about some of those other rules later. Okay, so that was the most difficult one to talk through in my opinion. The third type of stock options are RSUs, or restricted stock units. These are way more common. Some companies even call them different things. Google's calling them GSUs, I think, right now. But they're basically just RSUs. So when you're awarded an RSU, there's no exercise dates associated with them. They just vest after a specified period of time. We've seen with our clients, it's common now to have a 4-year vesting schedule where you get 25% of them basically after 1 year, and then monthly or quarterly for the remainder after that. So when you get those shares, they're taxed automatically at fair market value upon vesting, whatever shares vest. And so there's usually these long schedules. And so those shares, the full value, not just the difference between a strike price, which doesn't really exist, and fair market value, the whole thing between $0 and $15 in our example, that's taxed as ordinary income once they vest. Upon subsequent sale of the shares, any gain or loss, the difference between those $15 a share and maybe 17, that would be a capital gain. If you held it for longer than 1 year, long term. If not, short term. And if you sell them, let's say you hold on to them, and it drops to $13 a share. Well, now we're dealing with the same rules, but with a loss. So they're your shares once they vest, but that difference, the total amount, is taxed as ordinary income. And then lastly, there's a special type of RSUs called PSUs, or performance stock units, number 4. And these are basically RSUs that the company has to hit some milestone or hit some performance target in order for them to come your way. But after that point, it's basically an RSU. There's some nuances. Sometimes the plans will allow you to defer receipt of those shares at times when the tax liability can be more manageable. But in general, that's the high level. So I'd love to give you an overview of these 4 types of stock options, and just as a big picture, this is the way my simple brain thinks about it. So NQSOs are the non-qualified stock options. Back with our example, if you have an exercise price of $10 a share, you are going to pay for that $10, and that's kind of like your basis, like any stock. But the difference between the exercise price and the fair market value is taxable as ordinary income, non-qualified. They don't get that favorable qualified tax treatment. The ISOs, on the other hand, these are not necessarily taxable. The bargain element, the difference between the exercise price and fair market value, it is an AMT preference item, but if you do everything right, those can receive long-term capital gains tax treatment. Hold on to them for 2 years after granting, and 1 year after exercise. The third type, which is more common these days to us it seems, are RSUs, where the entire amount, difference between $0 and $15 a share in our example, upon vesting, it's all taxable income. Sometimes, we'll talk about how to pay for those taxes differently, but this is just ordinary income, and then you hold the shares. And then lastly, PSUs, or performance stock units. These are basically like RSUs in the taxation, but you may or may not receive them depending on company performance.
All right, I am going to talk about how to exercise your options. So broadly speaking, there's four ways to do that.
I'll keep track for you.
And the last one is not used very often, but it is definitely an option in some cases. So number one is cash. It's just probably the easiest method to understand. You transfer money to your employer, or they're holding the stock, and then you use that cash to buy the options, and then you buy them. And then the ramifications for taxes are nothing's changed about what Robert just went over. But since you've used your cash to do it, it gives you a little bit more flexibility when you have purchased them. You can kind of choose a little bit more how you would like to deal with those. Yeah. And then I think then there's this cashless sell to cover option. This is honestly probably the one that we see people do the most, where you use the sell of the stock, whatever portion is needed to cover potentially the taxes or the exercise price, if you're doing the withholding, the taxes as well. But this is a method that a lot of people will use. So they sell a chunk of RSUs, and then they use some of that cash that they just generated to purchase the shares or whatever it might be that is needed, pay for the taxes in RSU situation. Something to be really mindful of with ISOs. If you are doing a cashless sell to cover, the sell of the shares to cover the expenses will be a disqualifying disposition, and then you lose the benefit on that gift amount or the bargain element.
For those shares.
For those shares.
Yeah.
Yeah. And it will be taxed as ordinary income. So really want to be mindful with ISOs of how you're actually purchasing those stocks. So, and then the cashless same day sell. And if you are only interested in the cash proceeds, sorry, let me go back to that cashless sell to cover. That's if you want to hold on to the stock.
Yeah.
Like if you really like that stock for some reason, and you're not going to get over concentrated, in our opinion. We have clients that do go over concentrated, but if you want to hold on to the stock, that's when you would do a cashless sell to cover. And then a cashless same day sale, that is simply, you're just going to liquidate the whole position, and then you're going to use some of that cash to cover whatever the sell would be. And a lot of times our clients will use that to cover the taxes as well. And then the last one is a stock swap. And this is used broadly and mostly when we're talking about mergers and acquisitions, right? So if your company is a small company that's getting bought and merging with Google, Google will say, we'll give you 1 share of Google to 10 of your X company. And then you're just a cashless swap, right? So it's just all we're doing is just a stock swap. Taxes are pretty tricky on these tax swaps. So you just want to you should consult a CPA on all of these. But on this one specifically, tax code on stock swaps can get pretty nuanced. So you just want to talk to a CPA in regards to that.
And then big picture, we want to talk about timing of when to exercise your options. And so everything Jesse just said about cashless exercise, which is I think an 83B, or you're bringing cash, that factors into this as well. Maybe you want to use cash to exercise or pay for the options, and you need to migrate it over to brokerage account and everything else. That factors in. So does how long you want to hold on to the shares. And so, as you can tell, we love diversification in general. There are some clients that are very bullish about their company, and we may talk to them about, well, maybe one strategy to consider is hold on to RSUs for 1 year to get long-term capital gains treatment, and then maybe your plan would be to liquidate those after you get that long-term treatment. So it is nuanced in terms of when to liquidate, but also when to exercise these options. So generally, if you expect the value of your company to go up over time, then you may want to exercise the stock options closer to the expiration date, because you can delay taxation until exercise, and you're less subject to the volatility of the stock price. A lot of air quotes here, very nuanced. So you want to talk with an advisor basically about whether your company's stock is an appropriate part of your portfolio, how concentrated you are, and to think about, what is your opinion about the company performance relative to those various types of risk. There's also some nuances, especially with ISOs. It feels like about 10 years is usually the number that if you delay to exercise them past that, you may lose those options. So don't defer forever. You want to have this as part of your annual planning exercise, that you're reviewing every single grant in detail to make sure that you think about exercising those. And then to manage the tax consequences of these options, you may want to exercise these options gradually to spread out the tax hit. So let's say you had a bunch of ISOs and you deferred 5 years to start exercising them, and then you really want to start diversifying. You may not want to exercise all of those options immediately. There's like $100,000 limit on bargain element with ISOs that you'll have to factor in. And so you just want to factor in, like, what is the plan over time to diversify this position, if that's what you choose to do. And so, yeah, in general, you want to think through what type of stock options do you have, how are you going to pay for it, what's the taxation, what is your plan, and then please remember to record every piece of documentation you have, everything in writing, your 1099B forms, W-2, your 3921 forms, if you're an insider, a 10b5-1 plan documentation. And really, the more complex it is in general, the more we recommend you work with an attorney or an advisor to really understand these in detail. So
yeah, I would say the greatest risk the risk that we see is just that over concentration risk. I know we've talked about it. We didn't really hit. And we have clients that get so much of their net worth tied up in one stock, but then the tax burden, because typically you're making a lot of money, becomes so great that it's hard psychologically to get over the taxes. But man, stock concentration risk is legitimately one of the largest risks to your wealth if you're not really mindful of that. So it's just a really, really important that you have a good strategy and plan that you stick to when it comes to options.
And maybe we should do another video in the future. Let's say you found yourself in that position and you have, $5 million of NVIDIA stock or something, and you don't want to pay a, $2 million tax bill or something. How do you diversify that position? That's a whole other topic, but we have a lot of strategies we can talk through with you if you found yourself in that position.
Great. So thanks for watching. Like, subscribe if you'd like, and subscribe.